You are listening to Keystone's Stock Talk Show, episode 264.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to chat with you again this week with Aaron away on assignment or vacation, you choose. I will kick off our Your Stock Our segment answering a viewer question on the ever topical Lightspeed Commerce Inc., symbol LSPD on the TSX, which posted improved Q1 fiscal year 2025 results last week. Despite this, the share price is down 34% year to date and 89% since their 2021 highs. I will take a look at the current quarter outlook and the valuations to see if Lightspeed, a company we have avoided for 5 years due to its lack of profitability, despite excellent revenue growth, is finally looking interesting. In a down market over the past week, Brett reviews a shining star from Keystone's small cap Canadian stock research, Cipher Pharmaceuticals, symbol CPH on the TSX. The stock was introduced as a buy to clients in late August 2023, so just over 11 months ago at $3.89 and has jumped 229% to close today at $12.80. Cipher is a specialty pharma company with a portfolio of early to late stage products. It is a cash-rich business and just made a significant acquisition. Brett will let you know what has led to the surge in the share price over the past 11 months. Finally, Brennan reviews Canadian fertilizer giant Nutrien Limited, symbol NTR on the TSX, which has seen its share price track lower over the past year after several quarters in which management has lowered guidance. Brennan lets you know if the bleeding is about to stop or could continue. All right, let's get to the show. My co-host, Mr. Aaron Dunn, he's away somewhere with that great family of his and the Killer Bees, Brett and Brennan. They are here to rescue the show. How you guys doing?
Doing well. Doing good.
Doing well. Anything interesting this weekend? I watched some Olympics. I was at the Money Show over the last 3 days of last week in Las Vegas. Flew in and did some commerce of myself with my daughter. We did a lemonade stand at the local park, and they raked in the cash, her and her friend. It helps to be cute, 9 years old, and holding some lemonade out. It was great. It was really fun. Then we had a festival around here. There's a Sea Fest, so I was down there for flying in from Vegas, got up at 4 a.m, and I think I finally passed out at 10 o'clock at night after some fireworks. It was, or 11 probably, to be honest. It was a good day. It was a good day.
Yeah, no doubt. In Olympic fashion, I ended up golfing this weekend, and then as well playing some beach volleyball. It was awesome because like I'm like 6'5", so just
That's
kidding.
True.
I'm not 6'5". I'm
reverse.
You got that
pretty short.
Flipped around.
Yeah, exactly. But no, it was a lot of fun. I like volleyball, but one thing that I was complaining.
So you reenacted the scene from Top Gun with Tom Cruise. You're like, what is that?
I have seen it. I do remember, but no, I can't say that.
With your friends,
but,
basically, right?
I guess
you played the
I
part of
guess
Tom Cruise.
I am a spitting
Right height.
image. Yeah, right height. Yes, absolute spitting image of him.
Mm-hmm.
But yeah, one thing
Maybe
that I was
Tom
gonna
Arnold.
say is I was a little upset. People were saying that they were able to watch the Olympic golf on the CBC app, but I didn't see it on TV at all. So I don't know if they just didn't air it. Do I not have the right channels?
But the CBC, it's funny because I was it was difficult for me to I could play everything when I was on the road on the Sportsnet app or the TSN. CBC Gem or whatever their app was that was playing it was not cooperating as well. So that it is what it is. But it I was a little disappointed in the Canadian men's basketball team. They lost just today when we recorded this, and the women's soccer team. I hate when soccer. I mean, they were 3-0. They went to penalty kicks and lost. Penalty kicks are just, you might as well flip a coin. It's about as fair as penalty kicks are. So I'd love to have seen them advance, but we are becoming a hammer throwing nation. I've noticed, and
That's what you've been
from
telling me.
here, in the men's hammer throw, we literally Ethan Katzenberg. I the last name escapes me right now, but from Nanaimo, which is close to where we are on the West Coast here. Tremendous, bested everybody by 5 meters. Unbelievable. It was great to see. Today, the woman that we have, the Canadian woman, is the world champion, and she is competing. So if we go men and women hammer gold, this is a hammer country. We are hammer forward in this country, and Brennan knows that.
Yeah, she did win. She won.
Yeah.
So
oh my God, are you kidding me?
There you go.
Okay, there we go. Spoiler alert. We should have said that. That is all. I think it's on tape right now. I'm going to throttle Brett for telling me. I'm just kidding. I'm just kidding. I'm actually not that as much. I'm into any competition where, at the highest level, it could be like tiddlywinks at the highest level. I'd probably watch it. But yeah, it's the speed that they get on the circle. I don't really even care. We won. That's what makes it great. And Summer McIntosh, I'll mention that too. Yep. I mean, 3 Olympic golds, 1 silver, unbelievable. So very cool to watch. I love watching it with the fam. It's kind of inspiring. It's cool. Anyways, we'll move on to actual finance. So crazy week in the markets, but we have a poll first, right? It kind of ties into that.
Yeah, we can go in the poll and we can talk about just what's happened over the past week. So the poll conveniently timed in, so you can blame me for this last week correction that we've seen. We do, and we should. Mm-hmm. So the question is, now that interest rates are falling in Canada and expected to fall in the US, and I would say more so than when I wrote this, do you believe the central banks will be able to pull off a soft landing? Which a soft landing just means no recession. It's not like a specific term, so some people might just say it's still economic strength, no economic weakness, something like that. But it's generally just no recessions. And 43% of our viewers say there's no recessions or a soft landing. And 57% say one or both of the companies will have a recession or a hard landing as a result of the central banks. Which is quite interesting, because if you look at I'll put up a graph for our viewers.
These are a couple of good graphs to look at.
Yeah, you can see over time, over the past 70 years, and it goes back before that, but I've about the 70 years of data. You can see how closely the Canadian and US interest rates follow. And then if you overlay recessions of them, I have the US recessions up, but the Canadian ones are very, very similar. There's a couple which the US had, but it's due to US internal politics. Normally they were short-lived back in like the 60s and 70s. But generally the recessions are very close together, and the interest rates are very strongly correlated. You can see it's when one's going up, the other one's going up, with maybe a few months legs, a few quarter of leg, and maybe a bit deviation on how high or how low the interest rates go over. And this is over a very long time. So you can just show how strong of a correlation the two happen. So if we see a recession in the US, we're probably going to see one in Canada, and even vice versa.
Yeah. Yeah. And when in that tightening, after that tightening phase, it's hard to avoid, I mean, there's a reason you're tightening, and then there's a reason you see a recession following that typically. But, whether we get there or not, we may. Kind of trying to always massage a soft landing. I've heard that for 25 years. And it's very nice to hear. It's very comforting for people to hear. But usually it's a bit of a thud, and the economy, still recovers following that. Again, it always does recover, but to think you can kind of massage these things out. I mean, we had a thud on the markets yesterday. I mean, everything happens so fast on the markets today relative to, 10, 20, 30, 40 years ago. But I would say, a recession is okay. It is okay. Mm-hmm. We don't have, it doesn't have to be a Great Depression. It doesn't have to be a depression at all. You can have a time where people maybe have to be a little more, have their eyes closely on their pocketbook. And, it's okay to have a period like that. Maybe you don't have the excesses of the other periods if you can kind of remember when, okay, I needed to actually mind how much money is going out and how much is coming in, and make sure I have more coming in than coming out, and I'm not borrowing as much. And I think it puts a discipline on people that they need, and that's what recessions kind of do. And they remember, okay, I can't just spend like a drunken sailor or like a drunken Brennan. One of the two.
This is true. This is true.
Yeah.
I just find it crazy how, how quick market sentiment, just all of a sudden can flip on a dime. Like it's just, the markets were continuing to go higher. There was so much talk about, this AI push is going to continue for years and years, and fuel the market. I don't know if I heard new normal, but I mean, I'm sure that was being thrown around, where all of a sudden, it just flips on a dime, where all of a sudden everybody's, running for the hills saying panic, panic. I've got one of my friends texting me in the morning on, yesterday, which was Monday. Obviously that was a holiday in Canada. And he's just, kind of freaking out. And, just don't worry about what the market is doing really day to day. Again, it's, what we're always preaching. It's the businesses or the quality companies that you're holding in your portfolio. And just to not pay too much attention or too much mind to, just the general, market direction or sentiment that people are, freaking out about. That's my thoughts, at least.
No, it's funny. We were just talking about it. The Canadian markets finally did something right. They took Monday off, right? They just said, we're done. We're going to step aside for the craziness of Monday. And, you see markets globally rebounding. Today, we're talking Tuesday. The Canadian market Tuesday is down, but it's just kind of catching up a little bit, down 1 point something%. You saw massive drops yesterday in global markets. It is, if you're going to take a day off, then take that day off, and then things have normalized a little bit. Whether or not, it's due to a weaker economic outlook or countless other things. Valuations, particularly on the large cap side of the market, and we're doing seminars that kind of coming up at the end of this month to talk about the valuations between smaller companies and larger. They were stretched on the larger cap side of the market. So to me, which influences indexes far more than the small cap side. So to see a correction due to just valuations, not even due to just what is going on in the economy or what's projected to go on in the economy, is quite natural at some point. It just happens to happen very fast these days. And, that's why you see a big drop in the markets in one day.
Yeah. And I really say that it's because we saw quite a few things happen at once late last week. So we saw Intel reportings was just awful, even for what the expectations were already pretty gloomy. And the stock was killed. So there goes your AI theme, your technology stocks really get hit by that. But then at the same time, you saw a weak jobs report. You saw the Fed not do an interest rate cut. Then you saw the Japanese central bank actually hike by, I think it was 15 basis points. But since they were negative for so long and now they're going back into positive, they really corrected. And there's something called the yen carry trade, which a large amount of big finance companies do. They effectively short the yen as a borrowing currency, then long a high interest currency. And that's been going on for 30 years. So once the yen interest rate starts to go up, they have to either rebuy it or they have to just hold out and pay that higher interest, really. And that hurts them. And you really saw that on the Nikkei index. It came back up 9% today, but it was down 20% from its highs only a couple weeks ago. So really a bunch of things just hit the market at once late last week. And I think that's really what's happened here. Is it wasn't just one bad piece of news. It was from different directions and multiple things all happening within a short period of time.
Yeah, all that hit late last week, sort of even into the weekend in North American markets. And then you have this panic buildup on a Monday. Mm-hmm. And that's how you can get that kind of gap down, which is scary. But I mean, for me, there are some companies that we've been looking closely at buying, and it can provide some businesses, because we get the question, oh, should I get out of this business? Should I get out of that business? There's some, even if you have a recession, there's some businesses, like we have a company in the portfolio for our small cap portfolio that is the number one iron supplement in Canada. That's the biggest part of their business. That does not go away during a recession or any time, but you can get a chance to buy what is a pretty good company at a discount because the market it's just selling off everything. Somebody has to raise cash. It's relatively illiquid. You can still trade in and out, but it's relatively liquid. So you have somebody hit the sell button, not for anything fundamentally that has gone on with that company or anything that will happen a year out. And you can get these bargains. That, particularly in the smaller side of the market, you look at those good profitable businesses, they can come on sale because somebody had to liquidate something else, because they did something else that was stupid in their portfolio, or and need to raise cash, or they're just panic selling. And you can get these opportunities to buy great businesses at a reasonable price, or a discount to what they were just a month ago, for example, if a sell-off continues. So I will be looking, I know we all will be looking to see if some of these companies, these 4 or 5 companies that we're looking at, have a drop that has nothing to do with their fundamentals today or going forward, and then you can really buy it, get a bargain, is what we're trying to do over the long term, and you can take advantage of these little panics in the market. Now, it may continue. I mean, there is certainly a justification when you look at, like we said, the high end of the market, large caps, the valuations versus smaller companies, or where they are just versus their historical valuations. There's certainly, given a slower economy, a reason to say, why are these companies trading at or close to historic highs? So there could be some opportunities on the large cap side to buy in. But I don't think, a 10 to 15% pullback in something that is trading, 40% above its historical average price to cash flow is not a screaming opportunity. So that's just like, I've seen many people say, oh, XYZ large cap stocks pulled back 5%. Like, should I back up the truck? If it was trading at a 40% premium to its cash flow multiple over that period, it's not a bargain if it pulled back 5%. Like, you need a 30-40% drop in the stock for it to start to look better.
Yeah, so if you're looking at the S&P 500, it's still up 10% year to date. Yeah. If you're expecting 8-9% average yearly returns, you still have that, and we're still only halfway through the year effectively, even after this drop. If you expect something to go up continuously, you're just going to be out of luck at some point. And if you're not expecting it, you're going to be that person who panics and sells the low and buys the new high. Yeah,
for sure. I mean, if you're talking about the index, it's up year to date significantly. 10% halfway through the year is a significant move. Now, it moves back from highs. That's not even, we're not even at, we're not at a correction or territory right now. It has to be further. So I think that people get a little trigger happy, thinking that and it is an abrupt move in a day or over a 3-day period. But are we sitting here like a kid in a candy store saying everything's on sale? No, that is not where we're at all. We'll tell you if we are at a point like that. It's usually people have capitulated. There's complete panic in the markets. I'm not saying I see that happening anytime soon, but if it is there, that's when that's when I would be buying a ton more than today. I don't think the pullback that we saw Monday, Tuesday is anywhere near a point where we're looking to just deploy a ton of capital suddenly.
Yeah, we're not at the 2008, the COVID levels, anywhere near that.
No,
yet.
Not at that. Not at the .com. It's not. I mean, and people, I think they're so myopically focused. If you look on FinTwit, like financial Twitter, on Monday, I was perusing that, and then you just turn it off. But it looks in itself under that day, people are myopically focused on that drop, and it looks like, like you hear somebody saying generational value type thing. I saw some tweets like that. I'm like, it's a 5% drop. Like, are you kidding me? Like, let's, so, I mean, you got to be focused more. You got to pull yourself back, look from 300 feet and see, yes, the S&P was down, but it's still up 10% year to date, which is basically above its historical average gain for a year. So you're at a good year right now, even with that drop. So it's not value, blood in the streets, nothing close to that. I don't think most people are thinking it is. So just take a step back, take a breath. And, there may be some individual companies out there, but the broader markets are not suddenly massively on sale. even after a drop like you saw on Monday. All right, I think we can move on. We got nothing else to kick here. Let's move on. I'm going to look at sharing my screen here. I'm going to look at Lightspeed. So I'm going to revisit Lightspeed Commerce Inc., symbol LSPD on the TSX. Trades around $17, $2.5 billion market cap, doesn't pay a dividend. But what does Lightspeed do? They're based in Montreal, Canada. They are a cloud vendor of omni-channel point-of-sale software to retail and hospitality customers. Software is used by 160,000, greater than 160,000 mid-market customers in North America, Europe, and Australia. Their applications power single and multi-location retail, restaurants, golf course operators, and other businesses to compete successfully in an omni-channel market environment by engaging with customers across online, mobile, social, and physical channels. The company primarily targets small and medium-sized businesses. Now, Lightspeed, let's look at the chart over the past 5 years. It's down over the past years around 65%, 89% from its September 2021 highs, which was in the range of $158. At the time, as the stock was climbing up, we called the valuations on this stock ridiculous, as the company was not profitable at those stages. Again, Lightspeed has proven to be an excellent growth company in terms of its revenue. It's light years ahead of most Canadian public companies in terms of revenue growth and the trajectory there. We can see in this table of revenue growth over the past 8 years, and the trailing 12 months figure there over the past 12 months. From 2014, when Lightspeed posted $39.9 million, the company has grown its revenues over the past 12 months to $1.32 billion. That's tremendously strong growth. But even with all this promise, when the company's valuations touched, and when it got up in 2021 2021 to September, it was $23 billion market cap on the stock. The near-term efficiencies of the market at this point were on full display. Again, a promising company, but this was irrational exuberance, particularly as the table shows. The company's operating loss has mounted over that period from $35 million in 2024 to $213 million over the past 12 months. But the profitability is improving, and we take a look at the progress in the recent reported Q1 fiscal 2025 numbers here, highlights. Revenue was up 27%, transactional-based revenue was up 44%, subscription revenue increased 6% year over year, but the net loss was there, 23 cents per share. It is an improvement from where it was last year at 32 cents in the last quarter. And adjusted per share is also an improvement, adjusted net income. Adjusted EBITDA was $10.2 million on the positive side versus a loss of around $7 million in the same period last year. Let's look at the outlook. Stocks are always trading forward, so we're looking at what this company is going to do in the next quarter and the next year in terms of management's guidance. Second quarter 2025. Revenue is expected to be approximately $270 to $275 million. Adjusted EBITDA of $12 million, so up from what we saw in the last quarter, where adjusted EBITDA was $10.2 million, so sequentially up. Now, for a little bit of color here on Q2, for the second quarter, management expects to see similar trends to the first quarter, with sales growth coming predominantly from transaction-based revenue as the company continues to expand adoption of its payment and capital offerings. For the second quarter, year-over-year growth, the company is lapping a significant revenue uplift due to the surge in unified payments, customers becoming live last year, so it's got some tougher growth comparables. Furthermore, Lightspeed's initiatives aimed at growing software sales will only partially be impacted in the coming quarter, expects more of an impact as we go through the year. For the full year, we can see the guidance here, revenue growth of at least 20%, adjusted EBITDA of a minimum of $45 million. Now, most analysts currently expect them to exceed $45 million. Let's look at the balance sheet here. It's very strong. Cash, $673.9 million. That is down from $722.1 million in the preceding quarter. There's no debt in the business, so the net cash is, sorry, that's the wrong figure. The net cash there should say 673.9 million. That is the figure from the preceding quarter. Now, here is the trend. The company is investing in growth, so you can see its cash moving lower, but a lack of free cash flow. With this lack of free cash flow, the cash on the balance sheet has moved 29% lower over the past 2 years. The market expects Lightspeed to be free cash flow positive in fiscal year 2025, so this may break the trend, which would be a positive. Let's look at the valuations here. Enterprise value to revenue over the past 12 months is 1.4. We don't really love that metric, but there's no earnings here, so it's hard to. You can't give a PE and the cash flow is very low, so it's a very high multiple off that. EV to adjusted EBITDA based on fiscal year 2025 estimates around 29 times. Again, the PE. There is no earnings, not even forecasted for this year on a net income basis, so cannot calculate that. Conclusion here: following a promising Q4 fiscal year 2024, Q1 fiscal year 2025 was a positive. The fiscal year 2025 guidance states the business can grow at a greater than 20% clip organically. That is a tremendous growth rate organically. Organic is what we look for in terms of a business. It's great to see. And it will drive better than expected margin expansion. We think that it will over time. Again, like I said, we're impressed by the strong organic growth rate, a metric we prescribe a higher degree of value to than some other growth elements, like say growth by acquisition. On the flip side, while adjusted profitability is moving in the right direction, I stress that it is only adjusted profitability. The guidance still implies just a 3.7% margin, which is very low. We reiterate our opinion that Lightspeed dropped the ball by not focusing efforts on producing cash flow years ago, and its current profitability margins remain rather pathetic and hold back the stock from moving higher near term in a market that is not assigning premium value to payment processing companies without solid free cash flow and net income margins. The stock trades at, again, 29 times EV to its fiscal 2025 expected EBITDA on an adjusted basis, which again, that is very high. The growth and strong balance sheet is intriguing, but we find growth with real profitability elsewhere. And in the near term, we're just monitoring Lightspeed.
Yeah, it's nice to see. I mean, profitability moving in the right direction. Again, they're still losing money, but again, it is nice to see at least it's in the general direction. The amount of times that we get individuals bringing companies to us where, they'll ask, how do you like this business? Revenue growth is absolutely tremendous, but again, losses are scaling with revenue. That is a massive red flag. Again, We're not in, like Ryan said, on Lightspeed yet. But again, we'll see what 2025 holds. We'll see, especially cash flow or free cash flow. Again, they probably won't be able to generate, but moving in the right direction.
Yeah, over time, I would see like this company has room for margin expansion, like meaningful margin expansion as subscriptions accelerate, payment penetration rises, capital expands, and like operating costs are controlled. And you're seeing it move in that direction, but they're not there yet. And you're still paying like 29 times forward EV to EBITDA. On a free cash flow basis, this company, the estimates out there, for them to make 9 cents or something. So you're paying $17. The multiple off of free cash flow is still massive. The balance sheet is great. Again, sometimes, and I've talked about this before with Lightspeed, it's a double-edged sword. When a company gets a strong balance sheet through raising equity, for example, rather than disciplined free cash flow generation, and they have never achieved profitability, they have that. It's kind of like a crutch for the business. And we see that. I'm not saying it has to be what's gone on here with Lightspeed, but we often see it as a crutch. And because they don't need to meet payroll each quarter, for example, with by generating cash flow, they can invest, they can do whatever they want because they have almost too much cash, this business. They've never had the discipline to create cash flow. I remember a couple of years ago when they, set out their course towards profitability. And again, that course was towards adjusted EBITDA profitable. So not actual profitability, but it was a 4-year plan basically. Well, the market, it was a 3-4 year plan. The market over that time has said this is not good enough, and the share price is just, and people who are watching this can argue with me, say Lightspeed's a great company. Look at the revenue growth. The market is telling you it's down 89% from highs. It's down significantly again this year as they come out and start to hit adjusted profitability. The market doesn't care. I mean, they're telling you it's down 34, 35% this year. There's been many small to mid cap companies that do process or produce cash flow that have done tremendously well for our clients in our research. If this company had a disciplined approach to producing cash flow, I think the valuations, the stock could be higher. But you're talking about a margin, like I said there, I think it's 3.7%. That is a very low margin. We fret over businesses with 10% adjusted EBITDA margins all the time. Now, again, I think Lightspeed could ratchet back some areas of spending and you could have a higher, but again, they have to do it. We see companies that spend, generate free cash flow, trade at reasonable valuations, and continue to grow over time. This company has the organic growth that's really moved up that we like to see. But, if they pull back on the spend to grow the client base, how profitable really are they? Or how much organic growth can this business naturally have? I question those things until we see organic growth combined with significant cash flow generation. And you're just not there yet.
Yeah, and one thing I would add is even on their revenue growth, their gross profit margin actually has been declining over time. So they're taking on less lucrative sales, which pumps up that revenue. Yeah, sure, that looks good. But you're not getting that same economies of scale if even gross profit was flat percentage, if it was 1-to-1. And then you get that operating income, and that's where that leverage comes in because those are relatively fixed. You're not getting that same degree here. Yeah, you're getting leverage on the operating because it's still relatively fixed asset. But when you're getting less of that variable expense over time, you'd have to look into the exact expenses because even though that's your traditional is you consider the cost of revenues variable, it's not always true. You'd have to look into the exact structure of it. But when you're seeing it decrease year over year, quarter after quarter effectively, that's a bit concerning because it can just mean the only way they're increasing revenue is lowering their incremental sale price. It's as simple as that.
Yeah. And those are the things that concern us with the business. It's pointing in a better direction than it was, 2 years ago, for example. But, that operating margins should come up over time. And we're not there. We're not there. And still, even you just look at the adjusted EBITDA multiple on the stock, it's 29 times. It's a high multiple. We've found many companies that are trading at, a half to lower that are growing, that have good balance sheets as well. And that's the discipline that we have when we're recommending companies. And that's what's had us out of Lightspeed and not, and told our clients to avoid it. And we're very happy we have over the past 5 years. All right. I think that'll kill Lightspeed for the day. Let's move on. I think Brett's got a look at a company that we did recommend over the past year. And that is Cipher Pharmaceuticals, a company that's done tremendously well for clients. And again, the balance sheet, but the profitability was there. And their balance sheet was obtained by generating free cash flow, which is great to see. And you have a discipline to be more profitable over time.
Yeah, so Cipher Pharmaceuticals, they've been great for us over the past year, and we'll really look into why we initially recommended and where they're at right now. So Cipher Pharmaceuticals, if you're not aware, symbol CPH on the TSX, is a specialty pharmaceutical company with a portfolio of early to late stage products. The company acquires products that fulfill unmet medical needs and manages the clinical development and regulatory approval process. The company grows through the expansion of its product portfolio, which is done by investing in drug development programs with favorable risk-return profiles. The company markets its products directly within Canada and indirectly through partners in Canada, the US, and Latin America. The stock is currently trading at $12.80 a share and a $335 million market cap. Over the past year, the stock has surged 272%, with the most recent jumping due to the deployment of its previously significant cash balance, which I'll get into in a minute of how they deployed it. Cipher has been a keystone recommendation since it was re-recommended after transitioning to its current formula in August 2023. At the time of recommendation, is trading at $3.89, representing a gain of 229% over the past about 11 months. So why did we recommend Cipher late August last year? The company had a strong cash position. It was both GAAP profitable and cash flow positive. The valuation was low given the downside risk because of its strong balance sheet, trading at 1 times the price to book and just under 5 times free funds from operations, or cash flow if you want to be simple about it. At the time, many investors would have just really overlooked the company due to the lack of growth in the financials. This is due to the portfolio being mature products. When you have mature pharmaceutical products, you don't really see growth. You might see a percentage here or there with demographics, but nothing which investors are really pumped up about a high growth product when you're seeing 10-20%, or even in some pharmaceutical companies when they launch, and you'll see 100-200% in early stage biopharmaceutical companies when their first product launches, things like that. That being said, the company did have growth products, even if they weren't visible on the financials, through its pipeline with a treatment for nail fungus, MOB-15, as well as a couple other products in its pipeline. But more importantly, it had the prospect to deploy its cash-rich balance sheet. And that was really a big part of our thesis at the time. Effectively, the company really, at the time last year, really checked all the boxes for what we want in a company. Profitable, strong balance sheet with growth potential at a cheap valuation. And that's really what we're looking for in whatever form, whether it's biopharmaceuticals, tech, REITs, anything like that. We need to hit those boxes. Now, let's look over how it played out over the past year. So the company continued to grow its cash position driven by internal cash flows. The pipeline of products continued to progress over time. You don't expect, when you have a pipeline of products, you can't expect, it's going to be hitting the mark in the next month when it's in stage 2 trials. That's not going to happen. It's never going to happen. And even once it's done stage 3, it takes a bit of time for regulatory approval. It plays over years or even a decade from the very start, not over the period of months. So you need to wait companies out like this. But then at the end of July, the company did announce it had acquired a profitable growth dermatology product from Parapro for $89.5 million US. They paid $40 million from the company's cash balance, and then they took on $40 million in a credit facility, and then they paid out the remainder in shares. Cipher acquired the Natroba products for the treatment of licensed scabies, as well as the commercial infrastructure of Parapro. The company expects to submit plans to Health Canada to bring the product to Canada and leverage its existing dermatology infrastructure. So going back to our initial thesis, they're now deploying their cash, and that's what we want to see. Because even though cash on the balance sheet is great, it's only really getting that risk-free return through treasuries or like instruments over time. So over the past year, it's been about 5% in cash interest, which is nice to have, of course, and it does lower the risk to the company, but it isn't the same return you get through having deployed cash into either equities or in internal company producing revenue producing assets, I should say. Of course, this has put Cipher back into a net debt position, likely in the range of about $35 million US, which is a weaker balance sheet relative to before, but that's overall still quite strong given its internal cash flows. Internal cash flows will be going up with this acquisition. The leverage post-acquisition will not be extreme and still actually has room for additional taking on of debt, albeit likely smaller acquisitions at this time until the company is able to use those internal cash flows, which will now be higher, to pay down that credit facility over time, and then redeploy that cash elsewhere once again. And that's really what you're looking for with the company with this strategy, is using the cash flows from one acquisition over the next 2, 3, 4 years, and then drive that into another acquisition. And then that really gets those compounding returns over the next 10, 15, 20 years. So looking forward, really what do we want to see? The company will announce its Q2 earnings later this week, which will give us a better picture of how the financials have shifted. The degree depends on how much they disclose, because the acquisition was after quarter's end, so we probably won't see the full details until Q3. But What we would like to see is the continuance of strong internal cash flows, driving a strong balance sheet, which allows the company to conduct M&A on top of those pipeline products, which can potentially add organic growth, notably the MOB-15, which is a treatment for nail fungus, with an expected Canadian market launch in 2026, and it has a $92 million projected market, and they'd expect to take a significant portion of that, as $92 million in potential revenue, that is, if they are able to take the entire market. And of course, if they're not able to, and they're able to take a significant portion, it would still add to the bottom line for them. What we wouldn't want to see now, though, now that management has seen really the share price being rewarded with an increase after an acquisition, is for them to jump into non-accretive acquisitions for the sake of doing acquisitions. You can't do that, as if it's not accretive and you're diluting shares or over-leveraging. Once the bad times come, which they eventually do always, if you do that, the shares will no longer be rewarded. You have the shares decrease in prices. If they're over-leveraged, that interest expense will hit. Or if you over-diluted, you just have a share count in the hundreds and hundreds of millions or billions of share counts, which you'll see in quite a few biopharma companies who end up doing that. So you can't just grow the revenue. You need to have them accretive. That needs to be on a per share accretive basis overall. And ultimately, we still need the company at a reasonable valuation. If it is, as you've seen, it's went up substantially over the past year, but if it keeps on going up at a certain rate, you still want to sell at a certain point. Not that I'm saying we're doing that, but that's what you need to look at, is you need to look at the overall valuation for the company, as you don't want to be buying something or holding something when it's at 100 times the sales. Like we always say, is even when buying a company, you want to still evaluate it when you're holding the company as well. And I will say we're going to be updating our clients, Keystone clients, with a full update after the earnings at some point soon.
Good. That's an awesome summary. I'm looking back at the report that we released. It was August 28th. The stock, it was around 389. We called Cipher a cash-rich, profitable specialty pharma business. At that point, it held 50%, just over 50% of its market cap in cash and no debt. The core products, Epuris, Absorbica, which are the leading products for treating severe nodule acne, were producing good solid cash flow. So you had that base of business that was growing the cash in the company, and they had the near-term growth expected from inorganic acquisition based growth. And we had interviewed management at that time. We said they had roughly, dry powder around 70 million if you included the debt facility US that they could deploy. They've generated cash over that period, so they deployed a little more, and they used some shares as well. Long term, so we had that base of business. We had the fact that management had outwardly stated that they were going to use the cash on the balance sheet plus the access to debt to buy cash producing only businesses. And that's what they've done now. They've bought a business that is producing cash and has growth ahead of it as they go into in licensing into other markets, bringing into other markets. And they had the organic growth potential from a promising product like MOB 015, or its nail fungus product, which again, Brett talked about the market size in Canada, around 92 million. It's one product that really owns about 90% of that. So they have the ability to come in and potentially disrupt that market, which is very interesting. Right now, it looks like a better mousetrap than what is existing in the market. I don't want to get into the complete details of that because we could go on and on about it. We've talked to management about this. We've actually talked to other companies in the industry that compete with them and trying to confirm whether or not, and it looks like, for sure that product is a better mousetrap. But so you had those things, and you had, the organic growth wasn't going to kick in, like Brett said, right away, but 2 to 3 years plus down the line, we saw some organic growth from very promising product and bringing on in the near term. Now, it took about 11 months, but that's really the short term in market scope. And they've now brought on, and you're going to see growth from what looks like an accretive acquisition that has growth also organically within itself. So, and that's how, again, and what were the valuations at this time? Well, you can only find this in the small cap sector, but the PE basically over the trailing 12 months, now there's some noise in the numbers, was 2.4 at that time. EV to EBITDA, though, was 2.69. price to EBITDA was 5.6, but tremendous value that you could buy this company at with all those attributes that we just stated. You're not going to find that in many. We have to go through like 3,000 companies to find one or two that you're typically not seeing it trading at those valuations with a potential for growth. But it checks off all those boxes, and we do like a base case scenario on that, a mid case scenario, and a high case scenario. And right now, the company's hit on the high side of that scenario for sure. And we continue to monitor it. We're holding it right now, but it is it shows a good example of when you do a ton of research and when you look for this, the profile of companies in this actually came up in our Canadian cash rich profitable small cap report. We'll be again in this fall conducting same research as we did that led us to Cipher. It was the first buy that we made in that report. We'll be doing the same research, but there was two other companies that were recommended. And even with this correction in the market, the laggard, I'm not going to tell you what the company, but the laggard is up 45%. The other company that released too is up 130, 140% as well. So all three of those companies done tremendously well. Again, we're looking for companies with that similar profile that maybe we'll see some, if the market's correct here, continued, we'll see some babies get thrown out with the bathwater, and there'll be some other companies that enter into our research that have this similar type of profile. Cipher certainly done well over the past year. You don't need many companies in a given year like Cipher that have a 230, 40% plus gain to really impact your portfolio. And, any of our clients who bought that company over the past year, that is powering their portfolio to some strong gains. You saw weak markets on Monday. Cipher has not been weak over this period. So it's great to see.
Yeah. Just mentioning on, when we're mentioning we have a base case, a bear case, and a bull case. Really, the thing that was great about Cipher is too, if you looked at the bear case, since it had such a strong cash-rich portfolio, wasn't very much. If you have a 50% in cash market cap, if it drops 20%, it can't go much lower than that.
And we had to assign some value to the existing Epuris product, which dominates really the Canadian market. There's value in that. You have the cash. It is a unique situation. And again, there's basically no to one, maybe other analysts, with any credibility really following the stock at that stage. And that's how you can find a mispriced security. Within a month, the company did a Dutch auction. So they bought back shares. Just a great scenario for this business, has how it's played out over the past year. And we want to share that because it's great to look at things you've done right in the past and try to replicate those in the future. And we'll continue to try to replicate the positive results that have gone on with Cipher over the past year. All right, I think that's it for Cipher. Let's move on to Brennan's going to look at Nutrien, which has kind of done not a similar type trajectory over the past year. Certainly a larger company, but what people ask us to value Nutrien all the time. It's a dominant player in the fertilizer market, potash and nitrogen in Canada. But because of the fluctuation in the underlying commodities, it is very difficult to value this company. So Brandon's going to take you through that.
Well, that's my analysis. So,
all right, we're done. Let's move on.
No, I do have some things to go over. But, generally, Ryan's hitting the nail on the head. But we got a question on YouTube asking, can we get an update on Nutrien as it continues to go lower? So Nutrien, NTR on the TSX. It's also NTR on the New York Stock Exchange. Currently trading on the TSX at about $64.62 with a market cap of just under $33 billion and a forward dividend yield of 4.6%. So Nutrien is the world's largest provider of crop inputs and services, playing a critical role in helping growers increase food production in a sustainable manner. They produce and distribute approximately 27 million tons of potash, nitrogen, and phosphate products worldwide, and they have 6 potash mines in Saskatchewan. My cousin actually works at one of them. So I covered Nutrien back at the beginning of 2022 when the stock traded at about $110 per share and with a forward enterprise value to adjusted EBITDA multiple of 4 times off of management's fiscal year 2022 guidance provided in May of 2022. But throughout 2022, the company lowered its initial guidance in August and then again in November because potash prices were sliding and wasn't as tight of a market that management had expected. And these decreases in guidance followed into 2023, revising guidance lower in Q1 and Q2. So looking forward to the full year, fiscal year 2024, management is guiding toward potash sales volume of about 13 to 13.8 million tons, which compares to about 13.2 million tons in 2023. Nitrogen sales volume guidance of about 10.6 to 11.2 million tons, which compares to about 10.4 million tons in 2023. And phosphate sales volume guidance of about 2.6 to 2.8 million tons, which compares to 2.6 million tons in 2023. So they are anticipating growth in volumes here, essentially. However, the company revised its guidance practice in 2024 to focus on providing forward-looking estimates that they believe are of value to shareholders and are less impacted by changes in fertilizer commodity prices. And as such, they only provide retail adjusted EBITDA guidance of 1.65 to 1.85 billion. But they indicate that they are now providing adjusted EBITDA price sensitivity charts in their investor presentations for each commodity. So this is where they're, pushing investors to look now. So looking at these charts, if the price of its commodities stays around the midpoint of their sensitivity analysis, we're looking at approximately 5.6 billion in adjusted EBITDA for 2024, whereas they achieved about 6.1 billion in fiscal 2023. So this would place the forward enterprise value to adjusted EBITDA multiple at this time around 6.6 times, which is essentially more expensive than both times that I covered the stock on the podcast. Now, moving to the most recent financial results, just very quickly here. We are recording the podcast on August 6th, but the company reports its Q2 2024 results tomorrow, August 7th, after market close. So looking at the Q1 2024 results reported back in May, keep in mind their results are in US dollars. Revenues were $5.4 billion, a decrease of 12% over Q1 of 2023 due to lower net realized selling prices across all segments. Adjusted EPS was 46 cents per share, down about 59% year over year, and adjusted EBITDA was down 26% year over year to 1.1 billion. Now, looking at the balance sheet, as at March 31st of 2024, Nutrien had net debt of about 13.1 billion. And using that forward 2024 adjusted EBITDA that I previously cited, they have a forward net debt to EBITDA multiple of about 2.3 times. So to conclude on Nutrien, this is really just a quick segment, but fundamentally, I do think that it is a good business. They're still cash flow producing, but like Ryan said at the beginning here, he stole my thunder. It's a very hard business to predict. As I went over, many potash companies had lofty guidance in 2022 and 2023 with expectations of potash prices to remain high due to what they thought was a tight market. However, management continued to revise guidance lower over several consecutive quarters. And as Ryan said, when I covered Verde Agritech, another potash company based in Brazil, he said, what is the point of providing guidance if you're just going to keep moving it around with the volatile price of commodities? We just can't rely on it confidently, as even management can be wrong on the market dynamics, which they were. So I certainly think it's interesting that Nutrien has now gone to a more lenient approach by simply placing in price sensitivity charts in their investor presentations and providing production guidance rather than a specific adjusted EBITDA range. And really, this is the bottom line. If the price of fertilizer goes higher, the stock will likely do well, and the opposite is true if fertilizer prices go down. So looking at my points that I have up on the screen here, Nutrien has been returning capital to shareholders through its dividend and share buybacks. It does pay a nice yield of over 4.5%, and the trailing payout ratio of adjusted earnings is about 56%, which is reasonable. The company does have long-term targets of growing its potash sales to about 18 million tons by 2027. They're currently, looking at about doing 13.5 million tons for 2024, and the nitrogen division is anticipated to do about 13.5 million tons by 2027, where it's currently around 11 million tons right now. Now, in April, management initiated a process to divest its retail assets in Argentina, Chile, and Uruguay. These regions account for approximately 3% of global retail sales and around 2% of adjusted EBITDA. And management said that these decisions reflect its focus on core geographies to enhance the quality of its earnings and cash flow, which obviously is good to hear. And the guidance, which I cited previously, did not exclude these regions, as management has no clarity on when a sale will take place. Now, the company is just lapping its tough comparable financial results from when potash prices were elevated, which I say is a positive generally. The balance sheet remains healthy. Now, if potash prices remain in the same range going into 2025, as long as production volumes do increase with their guidance, we should again see some growth back in its financials, which have been essentially non-existent for the past couple of years due to declining commodity prices or fertilizer prices. But, if you believe potash will do well over the next few years, you could take a position. But, just for like Keystone, we're looking for constant cash flow growing businesses, which Nutrien just isn't.
Yeah, it's really difficult to value a business like this. And you look back at the share price, and the market tells you it's been difficult to value. It's the start of January 2028 listing. It's around $69. Today it's below that price 6 years later, in that range. It's been as high as the $140 $50 range in the kind of COVID or post. I think it was the war bump that it got, the invasion of the Ukraine, but it's been as low as $40 as well. You can maybe trade this company. These type of commodity based businesses are very difficult to value the way we value companies, on a cash flow basis, growing that cash flow and cash flow per share basis. Highly fluctuative. The revenues have generally grown in Nutrien over the past, since 2014, but had a huge spike in 2020. It was 7.5 billion 2014, up to 37 on a trailing basis. So that looks like good revenue growth, but operating profitability has fluctuated significantly over that period. So it's very difficult to value them based on the way we would like to see a business grow and be valued. You take a different approach and you'd be more of a trader. You'd probably buy it when it had the worst cash flow that you've seen in the last 5-8 years or 5-10 years, and then you'd sell it when everything looked great. Like that's just and it's hard. Those are terms that are very they're nebulous, really, right? Like you don't, like, it looks great and relative to what, and it's there's not hard and fast rules, and it's very difficult for us to say, like, we can value a business based on its historical multiple to cash flow to see whether we think, generally speaking, it's expensive or cheap or reasonably priced at that point. This company, when it probably looks the cheapest, it's probably the time to get out, and that's a lot of commodity based businesses. But again, that is just a general, because you can have you could have 2 more years of it looking great, and you don't know where the commodity price is going. It just overlays another level of risk that is very difficult to forecast. If you knew how to forecast nitrogen and phosphate or fertilizer prices long term, great. You'd probably be very, very successful in investing in this company. Good luck doing that. Right.
But yeah, like the amount of times that, we come across the financials of a company, like in the steel industry, like I've got, Algoma Steel. I remember, steel prices were going absolutely ballistic, and all of a sudden the stocks, like, we're getting tons of questions from not clients, but, just on the podcast, I guess probably clients as well, asking like, wow, it's trading at 4 times EV to EBITDA. This is a screaming buy. But like Ryan said, it's when you're dealing with a commodity price, it's almost pays off to be that contrarian investor, getting in when all of a sudden cash flow is almost the lowest, and that EV to EBITDA maybe 20 times rather than the 4 times. And again, there's no, like he was saying, there's no strict rule that is going to work out. But again, this is just the issue and the difficulty with dealing with commodity based businesses that is so tough. When like Brett was saying, looking at Cipher, we saw that low valuation. We had confidence in the business's growth, beautiful cash rich balance sheet. We had a great case. But when all of a sudden we're looking at a commodity based business trading at 4 times EV to EBITDA, well, what happens when all of a sudden that commodity turns, and realistically looking forward, it should be trading at 20 times.
And with really all commodity companies, whether it's oil, fertilizer, coal, iron, anything that's like that, is so driven by macro developments, geopolitical. So like you saw before in the invasion of Ukraine. Yeah, which you're just simply not. If you are predicting the invasion of Ukraine on that month, like why are you doing that? And you're not a CIA analyst or something. That's what I would expect you to be doing. And I'm sure that there's some hedge funds that hire those types of people. But the thing is, you're not going to be able to do those predictions over and over again. You're not going to have that reliability, and it could really come from anywhere. So if it wasn't Ukraine, it could have been some other war. It could have been you could have had another pandemic. You are not going to have one person who's able to predict all these macro effects, which always impact commodities again and again and again. You don't have that reliability like you do with a manufacturing company, with even a pharmaceutical company with Cipher. You don't have that, and that's the issue again and again you have, and that's why management can't even predict it. The people who are looking at this stuff day in, day out, year after year, day after day, they can't predict it. So unless you somehow have some omniscient insight, you're not going to be able to predict the earnings and therefore the valuation.
Yeah, when you're investing in an individual company, you're building that investment case, and then you're trying to de-risk it. Well, you can build an investment case for investing in a commodity-based business, but it's hard to de-risk because you have to predict where the commodity price is going to be, and it's just overlays that risk that it makes it very volatile. There are rare commodity-based businesses that have increasing cash flow per share on an annual basis over time. Maybe if you're on the royalty side or something and you're executing tremendously well, you can do that. But it's very difficult. And then it often doesn't fit our criteria. And you often look back at where these businesses go. And that's what we'll do. If we found that commodity-based businesses over 20, 30, 40, 50-year periods, we're all doing this up over time. I don't know if you can see that, right? We would probably find a way to value them, but there is not the amount of charts that I see in that sector that actually go up in a jagged line over time are very low relative to, businesses where we can track cash flows and they grow over time. Like the Boyds of the world, the Hammond Powers, from way back, the Brookfield Infrastructures, like these companies that have that jagged upward trend over a 5, 10, 25-year period that we're looking for. It's very difficult to do that in the commodity space.
If you ever look at like a sell-side analyst or like a bank report, if you get that from TD or something like that, for most retail, that's probably your exposure to that. They'll say in their bear and their bull cases and their base cases, oil prices or copper or whatever it may be aligns with our analysts' expectations for this, because they have to build their valuation off those prices. And most of the time they're just as wrong as we are when it comes to commodity expectations. That's the reality.
Yeah. So if the commodity price moves 10, 20% off those assumptions, they're all blown out. It looks very concise, looks very well thought out, the analysis in there, but you can even have a 5-10% move and it can blow those estimates out of the water, and it makes that report basically useless. So and if your analysis is rendered useless by a 5-10% move in a commodity, you might as well not issue the report. And this goes back to the guidance that we saw there. I mean, you have management who intimately know the market, they know the company, and they're constantly revising that guidance. And then they've gone to a method that doesn't really even factor in cash flow. It just tells you how volatile that sector is. How can you then invest with certainty in those type of companies? I mean, that should give you an idea when you see management continually having guidance, having to revise it, and then going to a different methodology to try to capture some kind of forward guidance. It shows you that they don't have a handle on it. How the hell can you have a handle on it as an investor? So just know that, these are they're highly speculative, any commodity based business. You can find ways of playing the commodity sectors. We've done it. There's a gold related company that we've invested in, but it's been profitable for 12 consecutive years. I mean, there's ways to gain exposure to commodities that are different from the way most investors do it. We do it for our clients all the time. So, I mean, it doesn't mean you're precluded from investing in commodity or related businesses. You can do that, or you can find a special situation where, I mean, we're looking at a company right now. I'm not going to say the name of the company, but like it has, 50% of its, just like Cipher did, if it's market cap in that range in cash, and we could see a scenario where it could have more. And, you get some margin of safety. If you want to invest in a commodity-based business, please look for a margin of safety, whether it be the cash, some other way that it's doing business that's different from the typical commodity-based business that allows them to be significantly profitable every year. So these, you can do it. You just got to think a little bit outside the box and find unique companies. And again, that's the way we have gained exposure to commodities, and it's served our clients well over time, and we'll continue to do it that way.
Yeah. And that's
all right.
One last thing. Cause I mean, Brett brought this up earlier. And I do think that it's a good point. And just like for my own, I've learned this over the past 5 years, just from learning from Ryan and being in the stock market myself, but just how much a cash rich balance sheet or, a large cash balance can act as, protection to help for, a potential bottom in a stock. To make sure that, rather than if all of a sudden there is a downturn, rather than a stock running from, $2 down to 10 cents because they've got debt, it acts as a floor, essentially. Yeah. So again, I just think that is something, especially when we're looking at a commodity-based business, that's something that you're going to want to help, mitigate the risk. Anyways.
Yeah.
Kill the show.
Good. Okay. Thank you. That will end off the show for this week. If you're watching us on YouTube or wherever, or listening to us, but if you're watching us, smash that subscribe button. If you are listening to us wherever you consume your podcast, we'd like you to rate and review us. I'm not going to this time ask for positive reviews. Just rate and review us would be great. But and we'll continue to provide that content on a weekly basis. Keep your questions, again, coming into our Your Stock Our Take segment. We'll answer those on a weekly basis. And as always, I wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.